Most people walk into a mortgage thinking they need 20% down or perfect credit or that pre-qualification actually means something, but those ideas are actually myths and they're costing buyers thousands of dollars. In this video, I'm gonna bust the 3 biggest mortgage myths that I see every single day and help you save money, time, and a lot of stress. But before we get into it, if it's your first time watching, hit subscribe and also get notified on all the future content we're putting out every single week. Now let's get started. Myth number 1 is that you need 20% down to buy a home. And this is one of the oldest and most damaging myths that I hear. Where did this myth actually come from? It was passed down from previous generations and the way that they managed money and finances. And they were actually taught that mortgages are bad and really an evil thing. So they were taught to put down as much as possible, even 30, 40, 50% or more, which that actually was the normal thing to do back in like the early to mid 1900s. But the truth today is that there are conventional loans that allow as low as 3% down, FHA loans with 3.5% down, government loans like USDA or VA with 0 down, and down payment assistance programs as well. So not having 20% down doesn't mean you're irresponsible or that you're not ready to buy a home. In fact, many of my clients have used low money down programs to keep more cash in their pocket and still get a great loan. So let me tell you a story about clients of mine who just recently bought a property named Dan and Vivian. And Dan and Vivian were well qualified. They had more than enough money for a 10% down payment, but they ended up buying with just 3% down instead. And they used the extra cash that they had to then renovate and build equity even faster in their property. Now, the second myth that you need to understand is the myth that you need perfect credit in order to get a mortgage. Now, I've personally helped buyers with credit scores as low as 500 get into homes or refinance. I don't want to make it seem like credit doesn't matter, because it does, but credit and credit scores is only one part of the entire loan equation. Some loan programs are built specifically for people that have credit issues or past challenges. And I've seen people actually get better rates than they expected because of how we structured their file and the certain loan programs that we use that are more favorable for lower credit. So let me switch over here to the whiteboard for you and show you exactly how your credit score can affect the type of loan that you get. So let's talk about the different credit types. So we'll talk about excellent credit, good credit, fair credit, and then poor credit. So the first question is going to be, which tier are you in? And how do you know that? Well, it's based off your credit score. So generally speaking, if you've got a 720 plus credit score, you're going to be considered excellent credit. No matter what loan program, depending on the specifics, 720, 740, anywhere in there is going to qualify you for the best programs, the best terms, the best interest rates. Now, good credit. What is good credit? Well, good, I would say, is anywhere between 680 and 720. So if you're anywhere 680 to 720, that's gonna put you in a good range. Now, the next one's gonna be fair. Now, fair is gonna be, say, 620 to 680. Anywhere in there is gonna be a fair credit score. And then poor is gonna be under 620. If you're, anywhere under 620, you're gonna have limited options for loans. You're definitely gonna be in that poor category. Now, other than poor, these other ones, you have multiple loan options available to you, but I wanna focus in and explain what the best loan program are based on these score tiers. So if you're an excellent credit, you've got the world at your shoulders, really. You've got anything that you want when it comes to loan programs. But the most common is definitely going to be a conventional mortgage if you're a 720 plus score. Those are the mortgages that are backed by Fannie Mae or Freddie Mac. So that's excellent. Now, moving down here to good credit, 680 to 720. There are certain circumstances where a government loan like FHA may be better, like if you have a high debt to income ratio. But in most cases, if you're 680 to 720, then a conventional loan could be a really good option for you. And the pricing, even with these credit scores, the pricing, meaning the interest rates, can be very good. They can be very favorable in the 680 to 720 range. Now, where it starts getting really iffy on conventional loans is when you hit that fair level. So generally in the fair level, we're going to be focusing in on FHA loans. If you're eligible, like a VA loan would be great. These loans have special criteria for people with lower credit, and they don't penalize you on the loan terms and the interest rate nearly as much as the conventional loans do. So there's kind of a sweet spot here in the 620 to 680 where these loans, you're going to get phenomenal, really, really good interest rates because, again, they don't penalize you for your credit like these other ones. And now for poor, you're really going to be limited here to just, again, same thing, FHA and VA loans, because those loans are the only ones that are going to not have that penalization for the lower credit and still give you the ability to get into a home. Conventional loans actually have a floor at 620 where no matter how much you're putting, you can't qualify no matter what. But in the context of this video, we're talking about where you're going to get the most bang for your buck, where you're going to get the best deal based on your credit score. So hopefully this gives you some good information on what loan programs to target based on your score. Now, I want to spend a minute talking and telling you about a story of a recent client that came to me, and the client's name was Mikhail. And Mikhail was actually relocating from California all the way over to Connecticut for a job relocation. Now, he had owned a home several years ago, but he was recovering from some past credit issues, and when we ran Mikhail's credit, it came in only at a 655 credit score, and he was trying to put the absolute minimum down that he could. So we got him pre-approved for an FHA loan with 3.5% down, and the amount that he was pre-approved for was significantly higher than he thought. And the reason we were able to do that is because using that FHA loan, we were able to do a higher debt to income ratio than a conventional loan. So he was able to get this home that was much higher than he thought, still within his budget, and he got under contract within just 2 weeks of getting pre-approved. Now, the third myth that I want to talk about here is the myth that pre-qualification means you're approved. So let's discuss what a pre-qualification actually is. A pre-qualification is not a loan approval. It's often just a quick look based on your basic information. And I've seen deals completely fall apart because someone thought that their pre-qual letter meant that they were actually locked into a mortgage. But what you want is an actual pre-approval, or better yet, a fully underwritten pre-approval. And that's what sellers will be trusting. That's what gets your offer accepted. So there's different levels of pre-approvals or levels of approvals in general. The first and the lowest level is going to be pre-qualification. And this really just entails you giving basic information like your name, address, and your income information, how much money you make. Maybe they'll run a credit report on you, but there's no documentation changing hands here. You're not actually proving that you have the assets that you say. You're not actually documenting that you make the income that you say. So this pre-qualification is definitely that lowest level because nothing's being verified. Now, the next level up in the mortgage approval is going to be a pre-approval. And this is going to entail getting all your information to the lender, but also documenting that information. So pay stubs, W-2s, bank statements, and asset statements to verify the information that you've given. We have to verify that everything that you're saying is true. And of course, at this level, we are getting a credit report for you to see what your debts are and calculate and analyze your debt to income ratio. So that's the second level. Now, the next level is going to be a TBD underwrite, or a to be determined underwritten approval. This is going to be the highest level of pre-approval really that you can get before you actually apply for the mortgage and go under contract. This is going to be really a full underwrite of your loan other than the contract. So all your income documents, assets, full credit reports, automated underwriting, everything is being submitted. And this means that an underwriter, a real person, is actually analyzing all of the documentation, really double checking all the loan officer's work and making sure that the information that was input into the loan application is 100% accurate and down to the penny. So a quick tip for you is, if you're in the process of buying a home or getting pre-approved, ask your lender, has your file gone through underwriting? And if not, find out if your lender offers these higher levels of approvals like TBD approvals and TBD underwriting. Quick story for you is that one of my clients recently beat out a property that had 5 other offers. And it wasn't because they were the highest offer, but the specific reason why they accepted their offer over the others was because their offer was fully underwritten. And the selling agent knew that this was going to be a quick and seamless process because most of the mortgage work was already done. Because of that, they accepted our buyer's offers. Now, these mortgage myths are everywhere on the internet, billboards, just all over. And these myths are hurting real buyers every day and talking them out of even trying to go through the process. But now that you know the truth, you can move forward with confidence. If you're not sure what's real in your situation, reach out to me. I'm happy to look at your numbers and help you cut through all the noise. Don't let a myth keep you from buying your next home or investing smart. Let's talk today.